Finance take the roll.
Absolutely. Mayor Pendleon is not on yet. Chairman Morris?
Here.
Alderman Karas?
Here.
Alderman Rummel?
Here.
Alderman Notes?
No.
Alderman Preschlack?
Here.
Alderman Gashgarian?
Here.
Alderman Bushman?
Here.
And Alderman Weber.
Here.
Mr. Chairman, you have a quorum.
Very good. So welcome, everybody. The first item on our agenda is the minutes from the Finance Committee meeting held on July 20th, 2020. Could I have a motion to approve?
So moved. Seconded.
I think we need a roll call vote. So Director Holub?
Chairman Morris?
Aye.
Alderman Karas?
Aye.
Alderman Rummel?
Aye.
Alderman Notes?
Aye.
Preschlack?
Aye.
Alderman Gashgarian?
Aye.
Alderman Bushman?
Aye.
Alderman Weber.
Aye.
Motion passes unanimously.
Very good. The second item on our agenda is the city mission statement and FY 2022 fiscal policy. As you may note from the email that came out, Alderman Bushman has suggested some alternate language on a few of the terms in the policy. It just recently, so what we've decided to do, and I'll ask the Director Howe to comment on this, but it seemed appropriate to defer voting on this tonight in allowing the members of the committee to look at Alderman Bushman's schedule this approval for the next Finance Committee meeting. So Director Howe, maybe if you have any comments?
Sure. No, just in talking earlier today about Mr. Bushman's proposed changes, we felt that given the agenda for this evening, as well as the agenda for the November 9th budget workshop, we would postpone to the January 19th Finance Committee meeting. Changes to this policy wouldn't really change the process of preparing and putting the budget together, so that would be fine. The delay would be for us from a staff perspective, and it would also allow everybody the opportunity, if they had any other suggested revisions, to incorporate that and get that to you as part of the packet delivery, so you have time to review that in advance.
Thank you. Any questions or comments from the Alderman?
Yes, Chairman Morris, I tried to phrase it in terms of questions, whether we want to make a change, and if so, whether there's a better way of saying these 5 points I did pick out. So I'm very receptive to better suggested language than I offered in my comments. And certainly any different perspective would be also very welcome.
That's great. Other questions, comments? Do we need a vote on this, a motion and a vote? Or can we just defer until the subsequent meeting?
You don't need anything formal. You can just have, just defer it and it'll just show up on the next agenda.
Very good. And with that, then I recommend we defer this and give everybody a chance to look at the suggestions and questions that Alderman Bush raised on a few of the terms in the policy. So thank you. The next item on our agenda is the 2020 property tax levy estimate. So I'm going to turn this over to Director Holub to comment on that.
Thank you very much, Chairman Morris. Amber is going to bring the slides up for you. And this is, you can go ahead and go to the next slide, Amber. This is really the first of 5 opportunities over the next 8 weeks for you to consider, discuss, deliberate on the 2020 property tax levy. Dates are listed here on this slide. So tonight as a Finance Committee, you'll get your first look at the property tax levy and have an opportunity to provide input. November 2nd, under state statute, this a non-binding estimate of the property tax levy will appear on the City Council agenda for consideration and approval. November 9th is the Finance committee budget workshop, and this item will be on the agenda, and that typically affords more opportunity for and discussion on the tax levy. And then we will return to the city council both November 16th as well as December 7th for first reading of the tax levy ordinance on November 16th and final consideration on December 7th. We're required to file the tax levy ordinance with the county clerk's office by the fourth Tuesday in December. Next slide, Amber. These schedules were included in your package. There's a lot of detail here, and so you know, I'm not looking for a lot of input or feedback today. As I mentioned, we'll have several opportunities, but we just focus in on the more important items from these schedules. This table is simply a calculation of the property tax extension limitation law calculation. So in other words, the tax cap on the city's levy. To make this calculation, we've used equalized assessed valuation estimates from the county assessor's office. So these are not certified assessed valuations, but they're their current estimate of EAV. The percentage you see highlighted in yellow is the change in the overall citywide assessed valuation from the prior year. So current estimates are showing a reduction in city EAV of 1.13%. And then just 2 lines below that, I just call your attention to the total estimated new construction growth for 2020. That is also an estimate we received from the county assessor's office. This would be modifications or new construction that are coming on the tax rolls for the first year. Under the tax cap legislation, that new growth is exempted from the property tax cap the first year it comes to the rolls. So you have one opportunity under the tax cap to bring that new construction on as additional tax levy revenue that is not impacting the rate on other existing property. And then just down at the very bottom, the aggregate levy truth and taxation estimate you see is 2.67%. That is made up of the tax cap applicable to this year's levy of 2.3%. And then the new construction number, which would add a 0.37, showing the allowable tax cap increase of 2.67%. Any questions on that calculation? Okay, next slide. This slide is the detailed tax levy worksheet. This provides the individual line items of the total tax levy for the city. And so you see at the top, the general fund levy, and then beneath that, the pension funds. So we levy dollars for both IMRF as well as public safety pension for the city. And then a section of other funds. So we include parks and recreation levies, capital improvements levy, and the library in the next section. And then you come to a subtotal, that's the total levy under tax cap. So in strict compliance with the tax cap, this is the aggregate levy that would be reviewed from a tax cap standpoint. And then below that, you have 2 categories of tax levy items that do not fall strictly under the tax cap. The first section being the bond funds. So we show the individual bond issues and the annual debt service for next year that is being paid from property taxes. The debt that is paid from other sources of revenue will be abated. And so you'll have abatement ordinances accompanying your tax levy ordinance that will get us down to this net levy, which is the total debt service to be paid from property tax revenue. And then the second category below that is new growth and allowances. So there is a small portion of the fire pension levy every year that is exempted from tax cap. The independent actuary gives us that amount. So that number of 120,316 gets added to the fire pension levy under the tax cap at the beginning of the page. And then we have special recreation. This is the special recreation levy. It is deposited to the special recreation fund and is restricted in use related to amenities afforded to those with disabilities. And so that has a separate and distinct tax levy limitation The city is well under it. And so you can see that that's included here with just the tax cap 2.3% as an estimate for now. And then the new growth, that's the amount that came from the previous table, calculated based on the estimates from the county assessor's office. That number, if you look down at the bottom of the page, gets split between the general fund levy and the library operating levy based on their proportion to the total. So you can see how, based on formula, that 116,000 would be divided between the general fund and the library levy. So in this worksheet, you can see the projected change, both dollar and percentage, in the third and fourth column. You'll notice that most of the line items for this purpose, for this evening's discussion, show the 2.3% increase under the tax cap. The exceptions from that are police and fire pension, which reflect here the actuarially determined required contribution based on the most recent actuarial valuation, as well as in the second group, the recreation and park specific purpose levy. That $125,000 was added a few years ago. It does not get annually adjusted, so there's no change in that line item. The capital improvements levy, one line above, that is based on the 5-year forecast of the capital improvement fund approved in May. So that has just a small increase over the prior year. The bond funds just reflect the bond ordinance from when the bonds were issued, and the annual debt service principal and interest were determined. So you see those changes delineated. And then again, on the fire pension Public Act 93 portion, that is reflected as the required contribution from the actuary. So in addition to that total levy under tax cap estimate that I showed in the middle of the page, there are two other calculations that we provide for the council each year. The first being the ordinance 2013-70 debt capital cap. So the city council adopted an ordinance in 2013 setting forth how the tax cap would be applied by the city from the perspective of capital improvements, either bond financed or through a capital improvements levy. And that cap currently, you can see to the right, is $3,525,580. So we add that up for you to show that the proposed combined levy for capital and debt service is $3,378,12, which is within that cap number. That is the one that adjusts annually for the municipal price index to stay consistent on an inflationary basis of capital and infrastructure construction that municipalities are using. So that is issued jointly by the Illinois Municipal League and the Northern Illinois University. And so that is that inflation adjusted cap. The second is the aggregate levy truth and taxation calculation. So this under state statute is a calculation that must be run in order to determine whether a public hearing and a black box notice is required in the newspaper. Under truth and taxation, if the proposed percentage increase is 5% or greater over the prior year's levy, then that requires the truth and taxation requirements to be met. So you can see that based on this worksheet, that calculation is 4.2%. I would note we have taken public comment every year related to the tax levy. It's not as formal as a public hearing, but we certainly allow public comment on the tax levy every year. Any questions on this worksheet?
Elizabeth, question on the reference to the bond funds. It shows a slight increase over the 2019 estimate. Now, we did the refinancing of the bonds, and you mentioned that that line item includes the annual debt service. And wouldn't we be looking at a significant savings in 2020 from that reduction in debt service?
Alderman Bushman, that's a fabulous question. We issued the refunding bonds in December of 2019. And so we came back in January and abated the 2019 levy for the refunding savings. So year to year, you're actually seeing both years here post refunding.
You said the 2019 extension. I was wondering whether you redid those numbers in light of the financing. Thank you.
Right. Okay, if there's no other questions, Amber, you can go to the next slide. The next slide is identical with just the blue lines changing. We will be talking about this more on November 9th at the budget workshop, but at the September City Council workshop, we talked about moving ongoing capital expenses that were more operating budget capital items from the capital fund budget back to the operating budgets. In order to affect that change, this is going to be a one-year shift of property tax dollars from the general fund to the Parks and Recreation Fund to address the components of the capital fund budget that is Parks and Recreation related. So there's a $285,000 amount that's CARP. There's $80,000 in tree replacement, $20,000 in miscellaneous landscaping, and $50,000 in ongoing recreation center equipment replacement each year. Those items will be moving from the capital budget to the Parks and Recreation operating budget, necessitating this shift of some of the tax levy dollars from one fund to another. So we just wanted to show this separately so that you could see it didn't have an overall impact on the total levy, but it will be an impact, a reduction in the general fund and an increase in the Park and Recreation Fund levy amounts over the prior year. Next page. Just some items to note related to the general fund fiscal year 22 budget. So we're just beginning to the development of the budget for FY22. So some items that relate to the property tax levy are identified here. So as you know, property taxes are the single most significant contributor to the general fund budget. In FY21, the property tax levy accounts for 56.3% of the total FY21 general fund expenses. On the expense side, as you know, personnel costs represent 74.3% of the total fiscal year 21 general fund expenses. And so we see natural growth in the expense budget in the general fund driven largely by salary and benefit cost increases to city employees. To give you an idea of the impact of personnel cost increases on the budget, each 1% of salary increase in FY22 for city employees would represent almost $182,000. So if you, for example, this year, the FY21 budget has a 2.5% salary increase. If that was, for example, the adjustment for FY22, that would be about $454,000 in additional money required in the general fund budget to cover that cost increase. And then finally, as I mentioned previously, there is a plan to move $900,000 from the capital fund, and this should actually say to the operating budgets because it's not only the general fund, but also the Park and Recreation Fund in FY22. This should free up dollars in the capital fund for other capital improvements. But as you know, from the September workshop, we talked about the fact that a lot of this recurring capital replacement we felt was more appropriate to be part of the operating budgets and reflect cost of services in the operating budget for those items. Next slide. The other point I just wanted to bring up was the public safety pension funding. So as you can see on the earlier slide, the most significant by far change in the levy relates to the police and fire pension funding. This has been an ongoing issue for the City Council, and we have currently developed a plan to phase in an open amortization as a more fiscally sustainable model for the city to fund police and fire pension funding costs. This chart shows us the 2019 update of the police pension modeler. The red line shows the expected contributions based on state statute, which is the 100%, or statute is 90% by 2040. We were using 100% by 2040. you see a steady increase going up through 2040 and then a significant drop off when the unfunded liability is amortized and we move down to just normal cost. Over the last few years, the pension subcommittee has recommended a different approach to phase in an open amortization, which would never reach 100% funding, but would get to about 85% funding using a 15-year open amortization. What you can see then is the blue line, where we would have seen a significant increase to move right to open 15-year amortization and then a gradual decline down. That significant increase in year one was the reason why the pension subcommittee and then the city council endorsed a plan to phase it in. So the goal is to, when we get to the crossover point, which is currently the 2024 levy, the fiscal year 26 budget, we would then at that point switch from the current funding model to the 15-year open amortization, and you can see what happens is a general decline. Pension subcommittee has talked about just flatlining that contribution and allowing the funded ratio to increase above 85%. But as you can see, in a few years, once we reach that crossover point, there's a lot more flexibility in levying amounts for public safety pension funding purposes. So we do see and forecast a few years of additional increases till we reach the crossover, and then we can flatline or potentially decrease that line item of the levy. The jump that you see between 19 and 20 in both lines is the impact of the interest rate assumption being reduced from 6.75 to 6.5%. We've talked about that this summer, and council endorsed that in adopting revisions to the pension funding policy in August. So that this model, this plan is factored in and does impact those increases on the police and fire pension levy lines. Next slide. This is our impact of an average household. So based on an $800,000, which is the average market value of a home in Lake Forest, what would the impact be on that homeowner's tax bill? You can see the calculations, but I just draw your attention to the yellow at the bottom right. Based on an $800,000 home, this tax levy estimate would increase their tax bill by about $132. And that would be for the proportion that covers the city and the library portions of the bill, which total about 25% of the total tax bill. So what we're asking for this evening is just a finance committee. You can go ahead to the next slide, Amber. Finance committee to consider recommendation of a tax levy estimate to bring to the city council on November 2nd. Again, that recommendation today, as well as the estimate approved November 2nd, neither of them are binding. And you will revisit the levy 3 consecutive times after November 2nd before finalizing the tax levy. So I will be happy to address any questions.
Jed, I think you're muted.
Yeah.
All right, there I go. So I was just saying that it's a complicated subject, and if you have questions, I recommend approving the motion, but for tonight. But if you have questions, I recommend that you schedule a time with Elizabeth to go out to MS or have a conference call, and she'll be happy to take you through it in more detail, how this all works, because it is a lot of information to absorb and to understand how all these pieces come together to resolve in the tax levy. So please give her a call if you have any questions. But if you have questions tonight, that's okay too. If not, I think we can entertain a motion to make this preliminary approval.
Yeah, so moved. And thanks for all your hard work, Elizabeth. Really appreciate it.
Second.
Director Alba, I think we need a roll call vote for this.
Yep. Mayor Panaleon,
He's on mute too.
Aye.
There.
okay. Chairman Morris,
Aye.
Alderman Karas,
Aye.
Alderman Rummel,
Aye.
Alderman Notes,
Aye.
Alderman Preschlack,
Aye.
Alderman Gashgarian,
Aye.
Alderman Bushman,
Aye.
Alderman Weber.
Aye.
Okay, motion approved, and we will bring this back to you at the November 2nd City Council meeting.
Very good. Thank you. The next item on our agenda is again, Director Hub, talking about the Laurel and Western Tax Increment Financing District Update. So Director Howard?
Thank you. We've got another set of slides for this presentation that Amber will bring up. We touched on the Laurel and Western Avenue TIF only briefly at the September 21st City Council meeting, and we advised you at that time that we would be coming back shortly with an update on the TIF district. So we are here this evening to provide that to you. So first of all, just some introduction. It's been a few years since we've talked about the TIF. And I know there's been some changes on the City Council. I thought it might be helpful to just take one step back and provide just a brief overview of tax increment financing. So in Illinois, tax increment financing is an ability, an economic development tool to utilize growth in future tax revenues to stimulate private investment within a specified redevelopment area. It is not a tax because it does not increase any taxes on a particular property, but it is also not a tax freeze. It is a tax freeze from the standpoint of the initial assessed valuation remaining constant through the time period of the TIF, but that is only due to the fact that the growth in the taxes are allocated to the Special Tax Allocation Fund and set aside for TIF development purposes. So it does redistribute new tax revenues in order to allow that revenue to be used within the district, and it is an important tool to leverage and incentivize public investment in defined TIF areas.
Elizabeth, could I ask a clarifying question?
Absolutely.
When you talk about tax revenues, are we only talking about property taxes, or are we talking about more than that?
In this case, we're only talking about property tax revenue. Okay, next slide, Amber. This is a very simple example, but if you have a small TIF district that has a property value of $10 million and taxes generated of $300,000, you create a TIF, and TIF spurs investment within that area, increasing the property value to $30 million and the taxes to $900,000. The incremental taxes of $600,000, the difference between $900 and $300, are the annual taxes that go into the Special Tax Allocation Fund and is available to pay project costs in the TIF. Another example in the next slide shows this visually. And so a successful TIF will generate and spur, incentivize investment within the TIF district, which should generate increased EAV and thus increased taxes. You can see that the base EAV remains flat through the term of the TIF, meaning that all taxing districts are receiving the same taxes, same tax amount for that property over the life of the TIF, because the incremental EAV and incremental property tax revenue is being put in the TIF fund. When the TIF expires, the general rule in Illinois is 23 years for a TIF district. A municipality can close the TIF early, but when the TIF does close, then that total EAV, including all of the investment in the TIF area, becomes available to all the taxing districts as new growth, which is what we saw on that earlier slide. So when a TIF closes, there's a very large amount of assessed valuation that goes on the tax rolls for all the impacted taxing districts. Next slide. Oversight. There's quite a lot of oversight for a TIF district. First, we're required to form a joint review board. The joint review board is a representative from each taxing district for all taxing districts that levy taxes on the property in the TIF district. So you will have a municipal representative, an elementary school district representative, high school district representative, college representative, sanitary district, any of the taxing agencies on property in the TIF have a representative on the joint review board. In addition, one public member on the joint review board. The joint review board reviews plans for development of a TIF and will take a vote in support of the creation of a TIF district. And then once a TIF district is established, the joint review board meets at least annually to review the annual TIF report, receive an update on development in the TIF, and then have any questions answered regarding how the TIF is performing. In addition, there's a TIF compliance report that is required. That is done by the independent auditors as part of the city's annual financial audit. So this year, Baker Tilly will issue a separate TIF compliance report indicating that their review of the financials and internal controls lead them to the summary that the city has complied with TIF requirements for the fiscal year. Annual TIF reports are required for submittal to the comptroller's office every year. So we have been preparing and submitting annual TIF reports since fiscal year 2015 on this TIF district. They're submitted again to the state comptroller's office, and they are made available to the joint review board at their annual meeting. And then finally, city council budget approval. So the special tax allocation fund is a fund of the city, is included in the total city budget, and is subject to the city council's approval of the budget annually. Next slide, Amber. So looking specifically at this TIF district, the Laurel and Western Avenue TIF district that was developed or created in 2015. This just gives you an aerial view of the previous site. This was the city's former municipal services site. The east-west street to the north is Franklin. The boundary to the east is Western, and the boundary to the south is Laurel Avenue. And this is a 10.7 acre area that was completely owned by the city and placed into the Laurel and Western Avenue TIF district. Next slide. There are a couple unique characteristics with this TIF district. It is very unique to have a TIF district in which all tax parcels are owned by the municipality, but that was the case here. There was one single family residential property that was acquired as part of the creation of the TIF district to ensure that the city controlled the entire boundaries of the TIF district. Because the city owned all but one parcel previous to the creation of the TIF district, it has a very small base value to start. The base assessed valuation is about $90,000. So any development, any increase in assessed valuation above that becomes incremental property value that goes into the special tax allocation fund. The benefit to this is that it really eliminated the risk of property values going down. So if you envision a TIF district being, a certain area of a municipality that has a lot of property owned by different property owners, in which the municipality wants to promote private investment, you could create that TIF district and then in very short order, in 2 or 3 years, see a general economic decline and see those assessed valuations go down instead of up, thereby eliminating any incremental property value and incremental property taxes going into the TIF district. And then in this particular case, the other unique characteristic is that the development type and pace could be anticipated by the city because as the TIF development was going through its particular process, the city was always also going through a deliberate process in selecting a particular developer to develop the site. Next slide. I will not go through all of this, but I think as outlined in the write-up that was included in your packet, we included the write-up from the April 2016 City Council meeting. That really summarizes the process that the city went through over a number of years, beginning with visioning processes in 2007 and 2008, going up to the January 2015 approval of the creation of the TIF district, and then the April 2016 actions to approve a revised purchase sale agreement, a redevelopment agreement, and a development ordinance with the selected developer focus. And then in September 2016, the sale of the property closed to Focus. Next slide is just the site plan to just orient everyone, that same area that you saw in the earlier slide. To the west, you see the 12 single-family home sites included in the TIF district, and then the building that goes along Franklin, and then the building that goes along Western, and then the building on Laurel to the right. Those three are the apartment buildings. Those are complete and open and doing quite well. They are 110 apartment units plus a model unit that serves as the leasing office. And as you know, those apartments were sold by Focus earlier this year. And then in the middle, the two buildings in the middle of the area are the condo buildings. The one to the north was 24 units. That is constructed and complete. And then the building to the south is envisioned as 18 units. The second condo building construction of that has not yet begun. Next slide. So now moving more to the financials related to the TIF district. So we used a TIF consultant, Tesca Associates, to assist the city on all of the financial analysis related to the proposed developments from the developers, as well as the cash flow forecasting for the TIF district. So what you can see here is just the graphical representation of the anticipated TIF revenue. This would be the incremental TIF property tax revenue that would go into the TIF fund. The TIF was approved in 2015. We knew that there would be a few years without any increment as the developer prepared the site and began construction. And then we anticipated a 3-year period in which those values would come onto the tax rolls and be completed. And then some natural growth in that property tax revenue through the end of the TIF period. Next slide. Within that projected TIF revenue, we modeled the different expenses that would be incurred as part of the TIF. And so I'll just go from the bottom of the chart up. And the light green and the orange relate to TIF impact payments required by statute to District 67 and District 115. There is a specific formula set forth that allows a school district within a TIF to receive impact payments during the term of the TIF. And the high school district is eligible up to a maximum of 13% of total increment received. And the District 67, the elementary district, is allowed up to 27%. So that totals 40% of revenues each year potentially being directly paid to the school districts. And so in our cash flow forecast, we included the maximum 40% there by year for each of those payments. The red and black hash marked expenses relate to a general obligation bond issue that was issued by the city in 2015. This was $5.09 million, and it was intended to support the cost that the city was going to incur to prepare the site in advance of closing on the sale of the property to the developer. So we had annual debt service, principal and interest, which you can see how that debt service is incurred each year, which we knew would occur in advance of any property tax increment, which would then be funded through an interfund loan from another fund of the city until the TIF fund had a positive fund balance. There is a very small gray line there that is the library. Also similar to the school districts under TIF statutes, a library district is eligible to receive up to 2% of the revenue under a specified formula. What we learned as we moved into the actual administration of this, it was assumed that the library was a separate tax district. But as you know, we have a municipal library in Lake Forest. So we did have the city attorney review that and found that under the TIF statutes, we were not able to allocate dollars from the TIF to a municipal library. So we had that in the initial cash flow forecast, but will not incur those expenses. The final two items, the dark blue and the light blue, related to a TIF note that is deferred proceeds from the sale of the property that was assigned by the developer to the city, which allows the city to repay itself the note, principal plus interest, from TIF increment proceeds. So that has a lot of fluctuation in it and can be adjusted. Those are the variables, and we will repay the city that note as quickly as the proceeds in the TIF fund allow. Any questions on the expenses?
Elizabeth, the monies that were expended for environmental remediation, are they built into the general obligation bonds, and that's how we're recouping those costs?
Yes, that's correct. We did issue that $5.09 million bond issue to allow the city the funding to do the demolition, do the environmental cleanup, and prepare the site for development. Okay, if there are not any other questions, I'll move to the next slide. This slide just represents how money flows between three different parties to the TIF. So you have the city entity in general, you have Focus as the developer, and then you have the TIF fund. And so we've got the arrows kind of showing the directions that money flows as a result of the TIF. So first to the right, Focus as a developer paid to the city initially permit fees associated with the development. The city received just under $2.4 million in permit fees related to the development. This money was set aside initially to fund any direct expenses the city had as the development proceeded. That fund has been closed and all remaining dollars were transferred over to the capital fund to fund the 5-year capital improvement program. In addition, at closing in September of 2016, Focus paid the city $5.6 million, which was about half of the $12 million the city was to be compensated for the property. That $5.6 million was used to pay in advance all remaining obligations on the 2008 GO bond issue. And that debt service levy was turned into the capital improvement levy that you saw in the earlier tax levy worksheet. Prior to that, the city had no tax levy on a pay-as-you-go basis for the capital fund. And so we use those proceeds to create that line item in the tax levy and provide ongoing annual tax levy support to the 5-year CIP. Then if we move then over to the TIF will make payments to in three different directions. So the TIF will pay to the city down the road the remaining proceeds of sales, so $6.37 million, which is the TIF note plus interest. as the cash available in the special tax allocation fund is available to pay that note off. The TIF was also established and would make payments to the developer for two specific items set forth in the redevelopment agreement. First, 1.15 million for off-site public improvements. Those public improvements have been completed and that 1.15 million has been paid to the developer, as well as $1.7 million in developer cost offsets included in the redevelopment agreement as phased completion payments. There were two scheduled phase completion payments anticipated in the redevelopment agreement, the first being $500,000. The developer met the requirements for the first phase completion payment and that $500,000 has been paid to Focus. The second phase completion payment was $1.2 million with an expiration date of March 23rd of this year. And due to the fact that the second condo building construction had not been completed, the developer did not qualify for that $1.2 million phase completion payment. So that payment has not been made. And then in addition, as noted on the previous slide, the TIF fund is also paying other expenses in the form of impact payments to the school districts and debt service on the $5 million bond issue, as well as administrative costs that are incurred each year simply in administering the TIF district. Any questions on the cash flows? Okay, moving to the next slide. So what is the status of the TIF today? So on October 1st, as noted, the apartments are complete. They began leasing in January of 2018. And as you know, recently, the Kelmscott apartments were sold by the developer for $53.75 million. Significant amount for that development. 5 of the 12 single family homes have been sold, and there is also a complete model. So there are 6 complete homes built on the 12 lots. The good news here is that the average sales price of those 5 homes has been $1.8 million, which exceeded our forecast of an average of 1.4 million. So that is good news. The first condo building is complete. 17 of the 24 units have sold. And again, the sales price, average sales price of those 17 units is $831,000, and that exceeds the forecast of $696,000 on average for each of the condo units. And then as noted, the second condo building projected to have 18 units the developer has not begun construction on that building. Next slide. So this is just providing TIF fund projections through the end of the current fiscal year. And so what it does is this summary in the forecast column shows where our initial TIF forecasts had projected the TIF fund to be as of April 30th, 21, compared to the current estimates of where we think the TIF fund will be at the end of fiscal year 21. So kind of taking these line item through line item, property tax increment forecast was that we would have received 1.6 million. As of April 30, 21, we're projecting just under 1.2 million. You can see that graphically represented to the right. And most of that is simply due to the second condo building not being completed and brought on the tax rolls. Bond proceeds came in as anticipated. We have some interest revenue on the funds that were not included in the original forecast. So in total revenue of 6.7 million forecasted, and we anticipate falling just under 6.4 million as of April 30th, 21. And then you can see the expenses by type. What we anticipate actual outflows of cash through April 30th, 21. Administration costs we think will have accumulated to about 424,000. Property assembly and site preparation, our forecast had called for about 3.79 in expenses through 21. We are forecasting now 3.6 million. The big difference here is the 1.2 million redevelopment agreement payment that the developer did not qualify for is not in this number. So had they qualified for the second phase completion payment, that total would have been 4.8 million. And then the construction public way improvements came in right on target. The additional 18,000 were some engineering fees that we incurred. Financing costs are coming in a little higher than forecasted, but that is going to come in significantly over the life of the TIF because of the way we handled the deferred sale proceeds through the TIF note. And so as that interest accrues and principal and interest is paid on that TIF note, we're going to exceed in this line item significantly the cash flow forecast. School district impact payments, you can see, are going to fall short of forecasts directly attributable to the reduced property tax increment. So they did qualify for their full 40% last year. We do anticipate them qualifying for the full 40% this year. And so that savings is just reflective of the reduced property tax increment generated to date. Library district, we've explained. And so total expenses of $7,062,858 projected through the end of this fiscal year is fairly in line with the forecasted expenses. Just noting again, the 1.2 million that has not been paid out. And then ending fund balance of the TIF was forecasted to have a deficit of 301,000 and not projected to have a positive fund balance until FY24 in the forecast. And you can see we're currently forecasting the ending fund balance of just under 700,000 to the negative. So any questions on that summary?
Hi, Elizabeth. This is Jim Preschak. Sorry.
Uh-huh.
Can you just explain the delta between the forecasted and the actual to date on the administration? I had noticed that in our workshop as well. And, you know,
Yeah, unfortunately, I think it was an oversight because it was not a line item included in the forecast. It was included in the TIF budget, but the administration fees weren't included in the cash flow forecasting. So that's going to remain an outlier. The total TIF budget for administration is 500,000. I think we'll remain under that because at this point, there's very little administrative cost. This was mostly incurred as we negotiated with the developer and worked through the implementation and bringing on the TIF when it was initially approved.
Okay, thanks. I appreciate that.
Mm-hmm.
So Elizabeth, when do you anticipate now that it will be a positive fund balance?
That's a great question. We projected this would be in FY24. We only know the increment each year. It's hard to forecast ongoing the property tax increment. We could probably work with TSCA and try to update the full 23 year forecast based on what we know today. I do not think it will be positive in 24 though. The forecast showed it going positive in 24. I think it would be at least another year or two before it was actually positive.
And it appears that really where we're different from the forecast is that second condo building hasn't come online. Is that accurate?
Yes.
And have we heard from the developer when he anticipates that coming back online? And further, why that hasn't, why it hasn't sold? I would have expected the single homes to sell last and those condos to go faster. So any explanation for that?
My sense is that, and I think someone else is popping in. No. My sense, Alderman Rummel, is that we knew that they would not begin condo building 1 until they had certain pre-sale numbers. And so my sense is that because they haven't fully sold the units in building 1, that they need to do that before they can start with building number 2. And I do think that there's some conversations going on, and I don't know if Kathy.
I'm actually happy to jump in.
Okay.
Just provide a little bit of context. We spoke to the development team just last week, and this was the first time we've had a conversation about it. I think, as Elizabeth noted, the condo market has proven to be a little softer than they initially anticipated. Certainly the apartments were very successful. Single family homes have done well. Condos have been a little slower, as Elizabeth had on an earlier slide. The prices for the units sold have exceeded projections, but the number of sales has just been a little slow. And so no question, as we think through future forecasts for the TIF funds, the two big issues sort of looming are how quickly will the second building get completed, and what will it look like in order to generate additional increment, and what would happen with a potential RDA payment for that second building, as noted on an earlier slide. Based on the current agreement, their ability to receive that second payment has expired, but they've reached out to the city, and we've just started very preliminary discussions about steps both parties can take to see that building does get constructed. And so I suspect we'll continue to have those conversations in the months ahead, and then perhaps seek some direction from the PPL committee before bringing something before the entire city council.
I jump in here just with some experience over at Amberley Woods, being a homeowner over there and seeing that project. That's still got a second lot there with a condo building that's not built. It's been 12 years later. So I'm certainly interested to hear further discussions come forth from the developer.
Mm-hmm.
Anything else on this slide? And then just the final slide, Amber, just a summary. So as of our current forecast through the end of this fiscal year, TIF increment coming in about 460,000 less than forecast, and thereby resulting in a less favorable fund balance than originally forecasted for 4/30/21. Second condo building construction has not begun. Developer did not qualify for the 1.2 million phase completion payment that expired 3/23/20. And so that $1.2 million is not in, again, the fund balance projection noted above that in this slide. And then TIF note repayment will be delayed. So our original cash flow had us beginning to pay off the TIF note back to the city in FY22. That will not happen in FY22 right now. I don't foresee it happening earlier than FY24. But a lot of that will depend again on how the TIF increment grows, and that is kind of the last payment that occurs each year when the TIF does have a positive fund balance going forward.
Can I just take off where Alderman Weber sort of left off? So what if that second condo building is not constructed?
So it would definitely affect the cash flow forecasting, and maybe that's the modeling that we should do going forward. I think that, as you can see from the first 2 years of payments to the school district, lower increment than forecasted results in lower payments to the school district. So it doesn't have a dollar for dollar impact on the TIF, fortunately, but it could significantly delay and potentially impact the ability for the city to get the full TIF note principal and interest. And so that is, for those who, George for sure, perhaps Jed, part of the conversations earlier, the initial forecast for the TIF fund called for about $6 million in developer support, which was going to necessitate a second bond issue. And so the city attorney and the city manager and the PPL went through different iterations and worked with the developer. And that's how we came up with this concept of deferring a portion of the sale proceeds, which eliminated the need for the second bond issue, but also delayed the city's ability to receive the full $12 million for the property. And so we really replaced that second bond issue with the TIF note in a form of seller financing. And that is much more flexible than a second bond issue where we would have, scheduled debt service requirements each year. So that in the end seemed to be the best financial option for the TIF in general. It also reduced the amount of debt the city needed to issue, but did require the city to effectively wait on full receipt of the sale proceeds of the property.
And, I'll just jump in to add as well that, based again on very preliminary conversations, I am confident that the developer is seeking a path forward to ensure construction of the second building. Could there be potential alterations to the original plan that was approved by the city, or could that be an ask? Perhaps, and probably a little premature at this point to comment on any specifics. But as I said, staff will continue to work with the developers to see how we can find hopefully an agreeable path forward to get the additional second phase of the building construction completed.
Well, thank you. I do think it's concerning, and it's something that we certainly need to keep an eye on going forward, because I don't think the projection, if we eliminate that second condo building, would look very favorable.
Sure. Well, and I'll just say, as we look at re-examining the redevelopment agreement with the developer, then it's an opportunity to look at, aspects of the agreement that, may warrant reconsideration, both from the developer's perspective, but from our perspective as well. So maybe there are opportunities for us to look at ways to accelerate the repayment. But again, my hope is that, maybe as we move into winter, that's something we can engage with PPL on and ultimately come back to the council for approval.
Thank you. So when would we, I just think maybe we need like a schedule of when we're going to be looking at this again, so that we're really keeping on top of it.
Sure, I can, we'll have some additional conversations with the development team, and then we can develop a potential timeline to share with the council.
Jason, a quick question. Melanie, were you all set? Jason, my question is it on the table that if condos are deemed to not be driving enough demand, that there's flexibility to change that to have the developer develop it as apartments, which there might be a deeper market for? Has that been anything that's been discussed?
Yeah, I'll say, without getting to any specifics of some of the preliminary conversations, again, I think there's certainly possibility to look at construction occurring in a different manner than what was initially approved, but ultimately, per the terms of the redevelopment agreement, that will require council approval. So, I guess the short answer is, if that's something that the city were interested in seeing happen, the council is the entity that will be able to weigh in on that with either support or expressing any concerns if you have it as well.
I'd like to
Thank you.
I'd like to make a couple of quick comments here. There are some countervailing factors, one of which is the extraordinary price that was paid for the apartments, far exceeding anybody's expectations, and will eventually, once the assessor catches up, provide some offsetting higher expectations in terms of revenues from the site. And then secondly, on the more negative side, I don't know that the competition from across McKinley was anticipated into our forecasts. The interesting thing there is, it does have a more favorable location. the units are much, much more expensive. And I think there's potentially a lesson learned there that, maybe, and we've had some just speculative conversations with the developer that maybe the condos are priced and positioned not quite where they need to be successful in this market. So we're talking about all those things. And I think that, but I do think it would be helpful if we could do some sensitivities on a couple of these different factors. How quickly the assessor catches up to the extraordinary price that was paid for the apartment project. What happens if the second building for condos doesn't get built? What happens if it turns into some other kind of, some other kind of development? Is it built as fewer, larger, more expensive condos? Is it built as apartments? All those things. As we go through this conversation with the developer, we're going to need to know what our preferences are. And really the best way to do that is to start with making some new projections.
Thank you, Mayor. Yeah, I would agree, because this can really have a significant impact down the road. So yeah, I would really like to see some different projections so that we kind of know what we're looking at.
Yeah, absolutely.
I would point out that we have an existing agreement and there's another party in this equation. So, we have to, everything has to be negotiated between us and the developer going forward, and the council will have, significant input on all that.
Is that all, Elizabeth, for this presentation?
That is it. Thank you.
All right, well, thanks, everybody. That was an excellent conversation and some really good questions, and thanks, everybody, for their input. That's just an informational section to our agenda. The next item is other business. There's 2 items that are available for questions to the director if anyone has them. That's on the flash report and the treasurer's report. Any questions on those? If not, the final item is an opportunity for anybody who's watching the committee meeting from the public to address us with questions or comments. So I'll ask Amber if you could let us know if anybody has questions or comments from the public. It doesn't sound like there is.
There are no calls at this time.
Very good. That leads us to the final item, which is the adjournment of the Finance Committee meeting for October 19th, 2020. Take a motion to adjourn.
So moved.
Second.
All those in favor?
Aye.
Aye.
Those opposed? None. Thank you very much. Thanks everybody who's watching for your patience. That went a bit longer than we thought, but we appreciate the opportunity to see what's happening from a financial perspective for our city. We'll do a little short adjournment and then we'll convene the city council in about 5 minutes, which is about 7:45. Thank you very much.